Hello everyone, my name is Farhan. Today here we have got a question for depreciation, which I'll run you through step by step. So you will find the question on the left hand side of your screen, and on the right hand side you will see all the workings which I'll explain step by step. So let's begin. Sunil runs a delivery business which owns many motor vehicles. The financial year of the business ends on 31 March. The following information relates to the motor vehicles of the business. So we know we are working with a business where the financial year ends on 31 March. This means that the financial year starts on 1 April and ends on 31 March in the following year. So you can see some information that we're given here in the table. And the first requirement of the question is to calculate the depreciation expense for motor vehicles for each of the 2 years ended 31 March 2017 and 31 March 2018. And then to find the profit or loss on the disposal of the motor vehicle. Now within the table, you can see that we are given the cost of motor vehicles at 1 April 2016, and the cost is given to us at $128,000. Then we are given the accumulated depreciation on motor vehicles at 1 April 2016, which is $25,600. Now, the accumulated depreciation stands for the total depreciation that we have so far since the date of purchase of the non-current assets. In the second information, we know that the policy is to depreciate motor vehicles at 20% per annum using the reducing balance method. All right. A full year's depreciation is charged in the year of purchase, but no depreciation is charged in the year of sale. In the third information, on 30 November 2017, Sunil's business sold a motor vehicle for $14,500 cash. The motor vehicle had originally cost $28,000 in May 2015. So I'll just highlight the dates here for now, because knowing what to do based on the dates are very important when you're solving a similar question in your exam. The fourth information says that on 10 January 2018, Sunil's business purchased a new motor vehicle, $32,500 by check. All right, so let's start with the first part of the question, which is to calculate the depreciation expense for each of the 2 financial years ending 31 March 2017 and 31 March 2018. All right, so just to give you a quick recap of the question. So we know that the financial year starts on 1 April and the financial year ends on 31 March. This is very important because this is also the clear reason behind how we calculate depreciation expense in a given year. Full depreciation is to be charged in the year of purchase, and no depreciation is to be charged in the year of sale. So let's look into the first financial year, which starts on 1 April 2016 and ends on 31 March 2017. All right. Now, in the first financial year, based on information given in the question, we can confidently say that there has been no purchase of new non-current assets, nor do we have sold any old non-current assets, right? So given that we've established these 2 information confidently, we can just first find the net book value at the beginning of the financial year on 1 April 2016 for existing motor vehicles. How do we find the net book value at any given point in time? We just simply take the original cost and subtract the accumulated depreciation, as you can see we have done here. Now, what's the original cost? It's given in the first line of the table, which is $128,000. And then we have subtracted the accumulated depreciation of $25,600. So once we have done that, we get a net book value of $102,400. All right. Now, because we're using the reducing balance method, it's important we know the net book value before we calculate the depreciation. Because when you're using the reducing balance method, the way we calculate depreciation is to apply the given percentage with the net book value. So we are using the 20% that's given to us in the question, as you can see here. Sunil's policy is to depreciate 20% per annum using the reducing balance method. So we apply this 20% on the net book value we have at the beginning of the year on 1 April 2016. And when we multiply 20% with $102,400, the depreciation in year 1 is $20,480, all right? So that's it. That's it for the total depreciation expense that we calculate for the first year ending 31 March 2017, given that in the first year we have not bought any new motor vehicles, nor have we disposed or sold any old motor vehicles, all right? Now let's move to year 2. And this is where things will get complicated, so I need you to focus and maintain proper concentration, all right? Okay, so in year 2, we understand that year 2 starts on 1 April 2017 and ends on 31 March 2018. All right. And in year 2, based on the fourth information that we're given at the end of the table, we know that we have purchased a new motor vehicle on 10 January 2018. All right. And the purchase cost or the purchase price of this new motor vehicle is $32,500. Okay. Now, what's the policy for this company to depreciate new motor vehicles or new assets? We depreciate new assets fully in the year of purchase. So although we purchased this motor vehicle sometime during the financial year, which is in January 2018, we still apply a full percentage. So what we're doing here is multiply the given percentage of 20 with $32,500, which is the original cost for this new motor vehicle. So that gives us a depreciation of $6,500 for the new motor vehicle. All right. Now we move to the motor vehicle that we have disposed or sold. So disposal of an old motor vehicle. So this information can be found in point number 3 within the table. On 30 November 2017, Sunil's business sold a motor vehicle for $40,500 cash. The motor vehicle had originally cost $28,000 in May 2015. All right. So we know the original cost is $28,000 and the purchase date or the purchase month is May 2015. Okay. And we know that we have sold this motor vehicle for $40,500 cash, which is referring to the disposal proceeds. So we do not have any information regarding the depreciation amount for each of the years we have held this motor vehicle or used this motor vehicle in the business, right? We do not have the depreciation amounts specifically. So what we have to do first is to calculate them ourselves. And this is very important. So make sure you maintain proper focus. All right. So for this motor vehicle, which we have disposed, the year 1 of this motor vehicle would be from May 2015 until 31 March 2016, given that we understand that we're working with a business where the financial year ends on 31 March, right? So regardless of whatever point in time you bought it during the year, we have to apply a full depreciation because of the company's policy. So full depreciation is to be applied in year 1, and the depreciation is to be applied by simply multiplying the given percentage of 20, which we know we have used before, and we multiply that with $28,000, which is the cost. So in the first year, we're applying a full depreciation, and full depreciation can be applied by simply multiplying the percentage with the original cost, which in this case is $28,000. So we are getting a total depreciation of $5,600 in the first year. All right? Okay. Now, year 2 for usage of this old motor vehicle would be from 1 April 2016 until 31 March 2017, right? And because we're using the reducing balance method, when you move to year 2 and you want to find the depreciation, it's important you also find the net book value first. The net book value is calculated by taking the original cost and subtracting the accumulated depreciation that we have so far. So the original cost for this motor vehicle is $28,000, all right? And the depreciation we have so far, based on our calculation from year 1, is $5,600, which we're subtracting, and that leaves us with a net book value of $22,400. Okay, so now we want to find the depreciation in year 2. You simply multiply 20% with the given percentage of 22,400, and you get 4,480 as the total depreciation for year 2. All right? Year 3. In year 3, would have started on 1 April 2017 and ended on 30 November 2017, the day we would have sold this motor vehicle, which is explicitly or clearly mentioned in point number 3, as you can see here, that on 30 November 2017, we sold the motor vehicle. So, based on the company's policy, we don't have any depreciation in the year of sale. So that's what we are justifying here. No depreciation in the year of sales. There's no need to calculate any depreciation. And this means that right during disposal, the net book value will be 22,400, which is the previous net book value that we had from the beginning of year 2, minus the new depreciation expense that we had incurred in year 2, which was 4,480, right? So that leaves us with a net book value of $17,920 at disposal, all right? Now, we will come back to this again when calculating the profit or loss in the sale of this non-current assets. At the moment, we don't worry about anything else. Now, anything else you think we can depreciate in between 1 April 2017 and 31 March 2018? Yes, the existing motor vehicles. We know that we have bought new motor vehicles. We also know that we have sold some motor vehicles, but what about the existing old motor vehicles that we have been using from the previous financial years and are also using in this year, okay? Now, what I need you to know is first find the net book value at 1 April 2017, which is in the current financial year. We know in the last financial year, which started on 1 April 2016 and ended on 31 March 2017, we had no purchase, nor did we have any sale of any motor vehicles, right? Are we confident with that? Yes. So once we have established that, we know that we can calculate the net book value by simply taking the cost that we were given earlier of $128,000 minus the accumulated depreciation of $25,600, all right? Then we are subtracting an additional depreciation expense, which was the amount that we calculated in between 1 April 2016 and 31 March 2017. Do you recall from part A? I believe so. So let me just scroll back up quickly to show you where we got that 20,480 from. So in year 1, we understand we had no purchase, nor did we have any sale. So when we found the depreciation in year 1, we first found the net book value of the existing motor vehicles at 1 April 2016 using the numbers that are given in this table. And once we have that net book value, we used the given percentage of 20 and multiplied it with the net book value to get the depreciation for that financial year, which was 20,480, right? Okay, so 20,480 is what we are subtracting here, right? And that leaves us with a net book value at 1 April 2017 of $81,920, right? Okay. Keeping aside the purchase of the new non-current asset in Jan 2018, what we're going to do is remove the net book value of the old vehicle that we have sold, all right? Again, we are keeping aside the purchase of the new non-current asset because we calculated the depreciation for that separately on the basis that we're applying a full depreciation. And what we're doing in this case is subtract the net book value of the motor vehicle that we have sold from this net book value that we had at 1 April 2017. Okay? So 81,920 minus 17,920, which is the net book value for the motor vehicle that we had sold based on what you have seen we have done for calculations previously, and we get a remaining net book value of 64,000, which refers to the existing motor vehicles after the disposal of after the motor vehicle that we have disposed is removed. Make sense? All right. So now we find the depreciation by multiplying 20 with $64,000. Okay. because we're using the reducing balance method, and obviously that gives us a depreciation of 12,800. Now, the total depreciation expense for this year, which would have started on 1 April 2017 and ended on 31 March 2018, is 12,800 that we had just derived for the old existing motor vehicle, plus an additional 6,500, which refers to the new depreciation calculated for the new motor vehicle that we had purchased. And there's really nothing else, because the motor vehicle that we had disposed, we don't have any depreciation in the year of sale based on the company's policy. So the only two numbers we're adding here refers to the depreciation for the existing motor vehicles plus the depreciation that we get for the new motor vehicle that we had purchased. So 12,800 plus 6,500 gives us $19,300 as the total depreciation expense for the financial year that starts on 1 April 2017 and ends on 31 March 2018. All right? Now, what's part B? Calculate the profit or loss on the sale of the motor vehicle on 30 November 2017. So what we want to do first is find the net book value during disposal that we already know for the motor vehicle that we had sold, which was $70,920. I believe you recall this. And then we know that the disposal proceeds, or the amount that we have sold this motor vehicle for, is $14,500 cash, if you read the information given in point number 3. Isn't that so? Right. So the net book value during disposal was $70,920, and the amount that we have sold this motor vehicle for is $40,500, which refers to the disposal proceeds. Now, what can we see here? We can see that we had more economic benefits within this motor vehicle that we had sold, right? But we ended up selling it for less. Like, we had $70,920 worth of economic benefits that we could have utilized within the business and help us generate revenue. But we ended up selling this for less than what it was worth, which is at $40,500. So you tell me, did we make a profit or did we make a loss? Obviously, we made a loss. And the loss on disposal, or the loss on sale of the non-current asset, is simply the difference between these two numbers, which is $70,920 and $40,500. So $70,920 minus $40,500 leaves us with $3,420, and that is loss on disposal.